Joining us is a notorious investor whose 15-year run beating the S&P 500 was unparalleled until it hit a wall in the financial crisis. Now he's out pounding the table saying it's time to buy. Bill Miller is joining us. Very happy to have him on the show. Bill, why now? What is so appealing about the situation where we've got 3.3 million unemployment filings?
Well, first of all, thanks for having me. Yeah, I think this is certainly one of the best buying opportunities of my adult lifetime. There have been four really great ones: 73, 74, 1982, 1987, and then 2008 and 9, and now this is the fifth one. And then, of course, interspersed with those, we've had a bunch of things that weren't as big, but also were meaningful. 1984, the NASDAQ had dropped 50%. 1990 was a recession. 1994, a mortgage crisis. 1998, long-term capital management. 2002, tech collapse. 2011, the euro collapse. 2016, a false alarm on a global recession. And now we've got 2018, we had a 20% drop in the market in the fourth quarter, and now we have an actual financial crisis. Those others were decent buying opportunities. I think this is a great one.
I got a lot of people coming on the show right now, Bill, who say this is not just about the virus. This is about structural inefficiencies and deficiencies that are now being exposed by the speed of moves in the stock market and crude that broke things on the way down. And that even though we got down here fast, we're not going to return with the same speed. They say the everything bubble is finally popping. What do you say to that?
Well, I wish I were clairvoyant enough to know exactly when this is going to recover and what's going to happen and how this thing fits in. I mean, my anecdotal view is that the structural deficiencies in the overall market were much greater in 2008 and 9 when the financial plumbing was coming apart. Housing was collapsing. People were flipping houses. There was way too much debt. It was like a Russian nesting doll thing. Right now, we've got probably, if you're going to have a financial crisis, this is the time to have it. The U.S. economy's never been stronger, unemployment never lower, inflation down, interest rates not a problem, returns on capital high. So the economy right now is obviously in a free fall because of the government mandated shutdowns. But I think the recovery will be pretty fast in terms of the overall economy. Maybe a quarter or two away. But I think with respect to the recovery from this decline, this very fast bull market collapse from the peak to the trough, at least an interim trough. I think you mentioned earlier that this is the fastest now bear market recovery, and that's consistent with what we've seen. There have been I think about 30% declines in the market since 1920. So one every 10 years. Interestingly enough, the last one was 08 and 09. So this is 10 years from the end of that, and it takes about half as long to have an interim recovery as we had a decline. So we had a decline that was about 6 weeks from peak to trough. So that would give you a 3-week or so snapback rally. So we're seeing this snapback rally. And again, I'm just giving you history. I'm not making a prediction, but I think those things are instructive.
What about right now the potential for a sustained period of weakness that is unrecoverable by municipalities? Assured Guarantee, the bond insurer, has been getting slammed right now, the municipal bond insurer, and I see more and more reports saying that places like here in Chicago, Illinois are going to be in serious trouble if this freeze goes on any longer than as 3 to 5 weeks. I mean, the bar here is pretty low right now in terms of what I hear from some of the systemic problems that pensions are now not going to be able to figure out their payment plans. I mean, what if there is a structural breakdown here? Do you not see that? Because I would imagine that would have some lasting effects, even if the virus just stops tomorrow.
Well, yeah, I mean, we used to own AGO. It's very well managed. It's entering this thing in the Assured Guarantee. It's entering this thing in the strongest position it's been in a long time. People had the same view when Puerto Rico went down, and they've recovered from that very, very well. I would say this is a different situation. I want to emphasize that Illinois is a basket case. They're going to have to eventually deal with their pension problems, as many other states are. But you may recall after 08 and 09, Meredith Whitney, a well-known analyst, basically said we're going to have hundreds of billions of dollars of defaults in the municipal market. It never happened. So I think these dire predictions assume that something bad's going to happen and nothing will be done to fix it. So this decline, again, this economic problem, which is clearly going to have a massive impact on municipalities, was government mandated. So when you think about comments like the bailout of the airlines, these aren't bailouts, these are rescues based on government policy to shut the economy down.
Now, on the other side, a few of the macro points.
It's unrealistic. Yeah. I'm sorry, it's unrealistic to assume that a Fed, which is now doing whatever it takes, a Congress, which passed a stimulus bill that's 10% of GDP, will just sit by idly and watch the state governments' all finances collapse. It doesn't fit with history or with the way human behavior operates.
With that point on the macro side and the relief package that we're getting right now, Bill, what we saw in 2019 was a market that ran up just basically purely on valuations. That can be shown pretty clearly in the data. The idea that the Fed has been overly supportive of everything from credit to stocks. There's a lot of folks that, again, they'll say, hey, your generational buying opportunity is now down at 17 times trailing PE. That's average. What the heck is that for a generational buying opportunity? Do you have to avoid places of the market that are too expensive? Or is this now a just kind of more normalized PE, an environment where the rates stay low?
Yeah, I'd say it's part of each, in the sense of you have to compare PE ratios to whatever else you can do with your money. And certainly one of them is bonds. So and interest rates, money in the bank. So it's very attractive compared to that. Now, and people have talked about owning gold. I mean, gold has no yield at all. It has no earnings, so it's got an infinite PE. But people talk about gold as a viable alternative. I'm not saying it isn't. I'm just saying that I think it's a little more complicated than to just quote a PE. I will say though that okay. I think that what you're seeing in this 3-day rally is a view about how this market will recover when it eventually recovers. That is to say, when it believes that the worst is over for the economy. And the answer there is it's gonna recover in the exact same way that it has from every recession-based decline in history. Namely, the companies that have the lowest PE ratios, the value names that you were talking about before, the companies that have leverage that have been able to survive through this, the cyclicals whose earnings are most sensitive to the economy, they will be the ones to come back at first and the most, because they've gone down the most. And I think that your growth names, the high growth names, and yesterday was an interesting day because the market was, before that late day decline that took most of the gain off, but like at 3 o'clock, the market was up 2.5%. Very broad market, yet Amazon, Facebook, Google, Netflix were all down in a strong up day. And they're lagging again today. So they're lagging because A, they're reasonably expensive, not terribly expensive, but they've also held up better. And if you look at the names that have gone up the most, they're all those deep cyclicals that have been collapsed. I mean, Carnival Cruise Lines, mentioned earlier, the cruise lines have come back from the highs, but I mean, Carnival was 8 3 or 4 days ago. Now it's 17. So that's I think indicative of the sorts of names. Not recommending any of those names, but the sorts of names that are going to do well.
So these type of cyclical stocks, there's those that fall under an industrial category, a transport category. We're talking now those that fall under the consumer side as well. Banks oftentimes also we think is cyclical. Is there a broad way to approach this? Do you have to pick the specific companies, Bill? Are you going in and buying the stuff here that people have been talking bankruptcies and Chapter 11 type stuff with? Are you wanting to take part in a stock like Carnival?
Well, no, we're actually considering Carnival. I would have rather bought it at 8 than 18, but we haven't ruled it out. You know, you mentioned about the fact that we really got hurt in the 2008 and 2009 decline, and it was we were down more than the market in that. It was a very bad period. But in the 10-year period since then, our funds in the top 1% of all funds. So it's not like that we've been laboring in obscurity out here. And the playbook that we did after 08 and 09 is the exact same playbook I'm talking about right now. And one of the things that we're doing in our portfolio is we're taking a look at all of the names in the market and where they traded kind of mid-January to mid-February before this decline. And that was when everything was fine, economy was fine, Fed is on hold, earnings are a record, return on capital is a record. So those valuations, we're giving you valuations that the market thought were the right ones to have in a decent economy and a good, very good stock market, with the stock market at its highs. So right now we've got a very different situation. And what we want to do is see what stocks, how stocks were valued then, and then assume that those are going to be reasonable proxies for what will do well in the next year or two.
Okay, now you've got two funds on the mutual fund side. I read a Bloomberg report that your hedge fund did 100% plus in 2019. Kudos on it, but for most watching, they're going to be looking at your mutual funds. You've got income, opportunity, and growth. I want to go to opportunity and growth first. How do you define growth in this? Is that where the cyclical names are going to come in?
Well, the opportunity fund is designed as a quote growth fund, long-term growth of capital, but it's a valuation driven. It's a valuation-driven portfolio. We're always trying to buy companies that trade at large discounts to our assessment of intrinsic business value.
Right now, what stands out? Do you need to have a big jump in the economy? Do you need to have as sharp of a rebound on the other side of this thing, Bill, to get those cyclical stocks to work? Who's going to want to hold on to a Caterpillar or an industrial parts maker if we're looking at a negative 20% GDP print that I'm seeing next quarter? Is it such a bet that that thing's going to come back as fast as it dropped?
Well, I wouldn't necessarily put Caterpillar in the kind of name we're looking at. Even companies that are cyclical may not be significantly mispriced. I think Boeing was significantly mispriced a week or so ago. But yeah, I mean, I'd say just your standard garden variety, lower PE names, good dividend yields, decent returns on capital. You mentioned the banks, which were sold off, are coming back strong today. But the big banks, the big money center banks, have the strongest capital position in their history. They've got good dividend yields. They generate huge amounts of excess capital. Yes, zero interest rates hurt their net interest margin, but these companies are not just spread lenders. They got a lot of other businesses, and I think those are good places to own as we come back. But to your point, no, if the economy flatlines and we stay down at this level, that is to say, we kind of stay in a muddled recession with a very slow recovery, those names will not do well. They will not do well until the economy actually gets on a decent footing, not a booming footing, but at least on a growth path of a couple percent again.
I think what's important here, Bill, for viewers is that it sounds to me, and correct me if I'm wrong, but the type of investment that you're describing is sort of a new post-recessionary era beta. That's cyclical stocks, and it's important because in the past 10 years, that's obviously not what's led this market. Anytime the Fed does big action, it's been high valuation tech companies, it's been whoever can generate the biggest sales and who cares about their earnings. Am I right in that you're avoiding that area? Is that not going to lead us, even though we just had the Fed pump this thing full of steroids?
So you make a good point, and a point I want to emphasize, which is there was a big change in the market in September or so, maybe September, October of last year, when WeWork collapsed.
Absolutely.
And it remains collapsed. And what that did was basically a wake-up call to people that companies that just can grow and grow at super fast rates, but that burn large amounts of cash and have suspect business models are maybe not the best places to put new money into. And so that whole group got smashed, and correctly so. And I don't believe that that's going to be coming back anytime soon as a group. There are names within that group that I think probably got oversold, but there are not very many of them. I would then, though, go back to the names I mentioned that were down yesterday, Amazon, Google, Facebook, Netflix. So real companies with dominant positions, those companies, with the exception of Netflix, which is still kind of expensive, but those companies in our view are not expensive, and those companies will do well. They just won't do as well in the short to intermediate term as the market recovers. That will be more for those cyclicals. We call them maybe new era cyclicals that you mentioned before, but companies with good returns on capital, decent dividend yields, and that are economically sensitive.
Love that point. I think pre-coronavirus, it's important that we don't forget that fourth quarter reflation trade that was trying to take hold. Bill, I got one more for you here. When it comes to one sector, when you have an income fund, a lot of folks think about income with real estate, utility stocks. Today they're rocking. Is that part of your income strategy, these groups, or have they gotten too expensive in their outperformance that has continued to stretch on here?
Well, our income fund has been positioned very differently from other income funds. First, it's a go-anywhere income fund. So it's not restricted just to bonds, for example, either investment grade or high yield. It can buy any company in any part of the world, any instrument, and any part of the capital structure that provides high income. And so what it has been since we started it has been pro-cyclical, meaning that we have thought that the recovery coming out of 2008 and 9, we started in 2009, would be slow and steady. It'll be punctuated by the kinds of things we saw in 2011 or 2016, but basically it'll be a slow and steady recovery. And so it did really well. Now, it's sold off a lot more than typical income funds now because it's pro-cyclical, and it's getting hit as it did the last time credit spreads came in 2016 or 15 or 16. But it's very well spread out. It owns REITs, it owns stocks, it owns high yield bonds. It basically goes anywhere where we think we can get high income and with reasonable credit coverage.